Think Dubai property is tax-free? That's only half the story. Here's what the agents never tell you. If you're a UK investor, you probably heard of all the headlines about Dubai's tax-free property market. But the reality is a bit more nuanced. And if you don't know the full picture, you could end up with some very expensive surprises. In this video, I'm going to break down exactly how Dubai's property taxes and fees really work for UK buyers. We will cover what you actually pay, what you don't, and the one tax trap that catches out more UK investors than any other. I'll also show you how Dubai stacks up against the UK system and share the strategies I use to keep more of my returns legally and efficiently. If you want clarity, not just sales talk, on Dubai's property taxes, you're in the right place. Let's get started. Let's start with the big picture. Dubai's reputation as a tax-free property market is one of the main reasons so many international investors are drawn here. And yes, compared to the UK, the difference is dramatic. In Dubai, there's no annual property tax. You don't pay council tax, there's no income tax on your rental profits, and there's no capital gain tax when you sell. For most residential property owners, that's the headlines, and it's absolutely true for the local perspective. The government isn't taxing your rental income or your capital appreciation, and there's no inheritance tax on Dubai property either. But here's where the nuance comes in. The tax advantages apply to everyone who owns a property in Dubai, regardless of nationality. However, if you're still a UK tax resident, HMRC expects you to declare your Dubai rental income and pay UK income tax on those profits, just as you would on any overseas investment. The same goes for capital gains if you sell your Dubai property while still a UK tax resident. So while Dubai itself won't tax you, your UK tax obligations don't disappear unless you fully break UK tax residency and establish yourself abroad. This is why so many UK investors are attached to Dubai's system. It's genuinely simple and pro-investor. But if you don't understand the interplay between Dubai local rules and your UK tax status, you can end up with an unexpected tax bill back home. So before you get swept up in the tax-free headlines, it's crucial to know exactly how the system works, what you really save, and what you're still on the hook for if you haven't left the UK tax net. In the next section, I'll break down every tax and fee you'll actually face as a UK buyer in Dubai, so you can plan with eyes wide open. Let's break down exactly what you pay as a UK investor buying, owning, or selling a property in Dubai, and what you still owe HMRC at each stage unless you're fully left the UK tax net. When you buy in Dubai, the main government charge is the Dubai Land Department transfer fee, 4% of the purchase price paid up front. There's also a DLD admin fee, usually around 4,000 to 5,000 dirhams, and your agent's commission typically 2%. If you're using a mortgage, you'll pay a one-off registration fee of 0.25% of the loan amount. There's no stamp duty like in the UK and no annual property tax. Now, if you're funding your Dubai purchase by selling UK assets, remember, any gains on those UK assets are subject to UK capital gain tax and you must report them to HMRC. Once you own the property, Dubai's system is refreshingly simple. There's no capital gains, there's no council tax, no annual property tax, and no local tax on rental income. Instead, you pay a 5% housing fee, a municipality charge based on the property's annual rental value, added to your monthly utility bill. You also pay an annual service charge to the building or community management, which covers maintenance and amenities. These aren't government taxes, but they are real recurring costs, and they can vary widely depending on the building and location. Always review audited service charges accounts before you buy, because underfunded reserves or deferred maintenance can lead to nasty surprises. Here's the part most UK investors miss. If you rent out your Dubai property and you're still UK tax resident, HMRC expects you to declare all your Dubai rental income on your UK self-assessment return, and you'll pay UK income tax on your marginal rate after allowable expenses. Dubai won't tax your rental profits, but the UK absolutely will unless you have broken UK tax residency. If you don't report this income, you risk penalties and back taxes. When it comes time to sell, Dubai doesn't impose capital gain tax or stamp duty on residential property sales. But as a UK tax resident, you must report and pay UK capital gain tax on any profits from selling a Dubai property. The gain is calculated in sterling, so currency swings can also affect your tax bill. If you become non-UK tax resident, you can potentially avoid UK capital gain tax on Dubai sales. But you need to be aware of the temporary non-residence rule. If you return to the UK within 5 years, HMRC can still tax gains while you are away. Inheritance is another area to plan for. Dubai doesn't levy inheritance tax, but if you remain UK domiciled, your Dubai property is included in your UK estate for inheritance tax purposes at 40% above the nil rate band. So how do you actually benefit from the Dubai tax-free regime? The only way is to break UK tax residency and establish your center of vital interest in the UAE. That means spending most of your time in Dubai, relocating your primary home and financial affairs, and severing substantive ties to the UK. Only then does your Dubai property income and gain becomes truly outside HMRC's reach, and the UK-UAE double taxation agreement helps avoid double taxation, but it doesn't override UK tax residency rules if you haven't genuinely left. Bottom line, Dubai's system is transparent and front-loaded one-off purchase fees, a recurring housing fee, and service charges, but no local income, no capital gains, or inheritance tax. For UK tax residents though, HMRC still claims its share on rental profits and gains unless you fully exited the UK tax net. In the next section, I'll show you exactly how these costs stack up against the UK regime and how strategic residency planning can transform your net returns. Now let's put Dubai and the UK side by side, so you can see just how different the numbers and the experience really are. In the UK, you're hit with a stamp duty upfront, which can be as high as 12% for additional properties. Then you have your annual council tax, which can easily run into thousands each year, plus income tax on your rental profits at up to 45% if you're at a higher rate taxpayer. When you sell, there's a capital gain to consider up to 28% on residential property. And of course, inheritance tax at 40% above the nil rate band if you're UK domiciled. In Dubai, you pay a one-time 4% transfer fee when you buy, a modest admin fee, and your agent's commission if it's not off-plan. There's no stamp duty, no annual property tax, and no local income or capital gain tax. The only recurring government charge is the 5% housing fee, which is based on your property's rental value and paid via your utility bill. Service charges are your other main running cost, but these are for building maintenance, not a government tax. The difference in cash flow is immediate. In Dubai, your gross yield is much closer to your net yield because you're not losing 20, 30 or 40% of your income to tax or levies each year. That means more money in your pocket and a much simpler ownership experience. But remember, if you're still a UK tax resident, HMRC expects its share of your Dubai income and gains. That's why the most successful investors I know either break UK tax residency and go all in on Dubai, or structure their affairs carefully with professional advice to minimize exposure. The bottom line is, Dubai's property tax regime is designed to attract and reward international investors, while the UK system has become increasingly complex and punitive. If you're looking for a market where you can actually keep more of what you earn, Dubai is in a different league entirely. Provide you understanding the residency rules and plan accordingly. In the final section, I'll share some advanced strategies and common pitfalls to help you maximize your returns and avoid costly mistakes as a UK investor in Dubai. Let's get honest about the traps that catch UK investors when they buy in Dubai, especially when it comes to tax and residency. On paper, Dubai's system looks simple and generous, but if you don't understand the rules, you can end up with a nasty surprise from HMRC or unexpected costs on the ground. First, there's a residency illusion. Just because you have a Dubai's golden visa doesn't mean you're automatically off HMRC's radar. If you keep your UK home, maintain UK bank account, or family stays behind, HMRC can and often will still consider you a UK tax resident. That means all your Dubai rental income and any capital gains from selling property there are fully taxable in the UK. The only way to truly benefit from Dubai's tax regime is to break UK tax residency completely. Move your life, your family, your finances, and spend at least 183 days a year in the UAE. Anything less, you're still in the UK tax net. The next trap is the temporary non-resident rule. If you leave the UK, sell your Dubai property while you're away, and then return to the UK within 5 years, HMRC can tax you on any gains you made while you were gone. Many investors miss this and get a shock tax bill years later. Inheritance is another overlooked risk. Dubai doesn't tax your estate, but if you're still a UK domicile, your Dubai property is considered for UK inheritance tax at 40% above the nil rate band. Only way to mitigate this is with proper estate planning. Think DIFC wills or offshore trusts, but most people don't address it until it's too late. And don't underestimate service charges. Dubai is not like the UK, where council tax is predictable. Service charges here can spike, sometimes by 20% or more in a single year if the building needs major work or the management changes. In some luxury towers, you could be paying more in service charges than you ever did in council tax back home. Always audit the building's financials and talk to the current owners before you buy. So who actually wins with Dubai property? It's the investors who go all in, those who are ready to relocate, break up ties in the UK, and treat Dubai as their true base. If you only have in, or you want a passive, hands-off investment while keeping your UK life, the full benefits of Dubai tax regime will slip through your fingers. In the final section, I'll show you how to structure your ownership, leverage double tax agreements, and avoid the most common mistakes UK buyers make, so you can actually keep more of what you earn. If you want to go beyond the basics and get real actionable answers on Dubai property taxes, residency, and advanced strategies for UK investors, join me for my next live webinar. I'll be diving deeper into everything we have covered today: how to legally break UK tax residency, structure your Dubai investments to maximize efficiency, and avoid the most costly mistakes I see UK buyers make. You'll get the latest regulatory updates, practical case studies, and a chance to ask your questions live. Whether you're just starting your Dubai journey or you already own property here, this is your opportunity to get clarity and expert guidance. No sales pitch, just straight answers. Click the link in the description below to reserve your spot. I look forward to seeing you there and helping you make the most of your Dubai investment.